Good afternoon, everybody. Welcome to another self-directed IRA Saturday. My name is Andrea Chassin, and I'm an IRA specialist here at Quest. We have a great show today. We have Derek from Gardner Capital Group, and we're really excited about his presentation. He's going to be talking about real estate notes. So can't wait to start. But before we do, we're going to go through our usual housekeeping and starting with our disclaimer. We do not provide any tax, legal, or investment advice or structuring advice or endorse any products, services, or investments of any type. So all information and material shared here today is for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any sort of investment. So very important there. We also want to talk today. Well, this is our QR code. So if you want to schedule a consultation with an IRA specialist, feel free to do so using this QR code. We're going to also be putting some information on our chat. So if you also have questions right now that we can answer, we'll be monitoring that as well. Thank you, everybody. So just want to tell you guys a little bit quickly about our double rewards promotion that we have ongoing until the end of this month. If you refer a friend, you both get a credit of $50 towards your accounts here at Quest. So take advantage of this if you know someone's kind of been looking for a self-directed IRA custodian or looking for, to fund their next deal with their IRAs. Then this is a great time to bank on that, I guess. So make sure you use it. Again, this is good until the end of this month. And then this is a little bit about our Gold Family department, which we've been featuring. It's a really good concierge type of service where you get a dedicated certified IRA specialist for all your needs and taking you through all the processes of what's investing with your self-directed IRA. Among other things, it's a great team. It's an amazing team of 4 women actually there. We're really proud of this department. So make sure you check it out, okay? And then last but not least, we have our Quest Expo that we're also featuring. We're letting everybody know that this is happening in June of next year. So we still have our little bit away, but time flies. And so it's always good to have it on your radar. It's going to be amazing. It's going to be in Irving, Texas, the biggest Quest Expo we've ever had. So excited for that. Stay tuned for more information. Scan the QR code for also to sign in and for more info on that. So that's all I have for you guys for now. And without further ado, let's bring our speaker of today so we can go ahead and get started. Hi, Derek. Thank you for joining us.
Hi, guys. Thank you for having me. Let me get my slides queued up here.
Yes, go ahead. Take it away.
And you guys let me know where to go. Y'all can see everything okay?
Yes.
Okay. Perfect. All right. Well, guys, everybody, thanks for joining me here on a Saturday to talk about a subject that I am passionate about. And thanks to the folks at Quest for giving me the opportunity to speak to everybody today. The goal for today's presentation is to give you guys a basic overview of real estate debt investing and specifically promissory note or mortgage note investing, and to educate everybody on what can seem like a pretty dry and complicated subject. So hopefully when you guys walk away today, you have some knowledge that you didn't have when you walked in, and you can understand where this type of a investment vehicle can fit in your day-to-day investing decisions. Presentation is meant to be very high level, certainly isn't meant to be exhaustive around all the different facets of note investing. Like a lot of things, you could do a separate 1-hour presentation on any of the single slides that I'm going to show you today. Good news is, don't worry about taking notes. If I fly past something that you thought was interesting, at the end of the presentation, I'm going to give you guys an opportunity to get a copy of these slides. So you got to stick with me till then, but just enjoy the presentation and don't worry about having to take notes. So with that, we'll go ahead and get started. They already showed a disclaimer. here's one that I have. Let's get all the boring disclosures or disclosures and disclaimers out of the way. Info I'm going to share here is going to be general in nature, shouldn't constitute legal, tax, investment, financial, or other advice. It's intended to be informational in nature, isn't a solicitation for investment. You guys know investing carries risk, and then past performance is no guarantee of future returns. So with that out of the way, let's talk a little bit about Gardner Capital, just to give you a sense of who I am and where I've come from. So I've been involved in one way or another with real estate investing for my entire life. I grew up in a family that was invested in a number of different asset classes pertaining to real estate, commercial, multifamily, industrial. I continued down that path with my own portfolio, single family rentals. I'm sure people on the call today have either done that or they have some now. Before I ultimately discovered notes, and I decided that was the direction that I wanted to take. It was a good fit for me. I started Gardner Capital back in 2018 with the exclusive focus of investing in seller financed real estate notes, and I'll get into the distinctions on what exactly that means as we move through this thing. So a quick agenda and what we're going to talk about. I'm going to do 4 broad topics. We're going to talk about an overview of notes, specifically promissory notes, to give you guys a grounding on the scope of the presentation. And then we'll zoom one level down. We'll talk about real estate and seller finance notes. Then I'm going to talk about what it means to invest in notes, what investors like me look for, what the risks are. We'll talk about how you can lose money. Nothing's a sure bet. And then at the end, we'll tie it all together, because this is certainly not the end all be all, and it is meant to be kind of one piece of an overall investing strategy. So with that, let's talk about just the overall investing universe. I'm going to do this by way of kind of zooming down into what we're going to talk about. But when you think about where you can invest your funds to earn returns, right? There's a number of different places. The entire universe encompasses a lot of things. It can be stocks, equities, bonds, real estate, private equity, venture capital. I have real estate on there twice just because I like it that much. But you can do any number of different things. So that would constitute kind of the investing universe. When you zoom down one level into real estate investing, the consideration set gets a little bit smaller, right? So now you've got things like in the equities piece, you got REITs. You've got single family rentals. You can invest in commercial. There's all kinds of opportunities out there now where you can buy fractional ownership in commercial properties that I've seen. You can invest in land. You can do all sorts of things, right? So there's still a pretty broad universe of opportunities. When you get down one more level, now we're starting to talk about real estate debt, right? So equity is not necessarily a part of the conversation. So this is where you're investing in loans and you're receiving loan repayment payments, right? You're the lender, and earning a return on the funds you've loaned. You're getting payments back, and the interest you earn is the return on that investment. When you get down into note investing, now we're talking about individual promissory notes that people have taken out in exchange for buying a piece of property, right? And they're paying over time. Everybody's familiar with that. Most people, I'm sure, either have had or have now a mortgage they're making payments on. So you're the payor in that arrangement. Now we're down at the very bottom. So now we're talking about seller finance notes and owner finance notes. So that's really the very specific portion of the investing universe that we're going to be talking about today. And with that, I will get into a quick overview here. Looks like my builds didn't work here. So in terms of a note, overview of notes, let's talk about what a note is. A note is defined as a signed document containing a written promise to pay a stated sum to a specified person or the bearer at a specified date or on demand, right? So that basically means you're going to borrow some money, or you're going to lend some money. The person you lend it to is going to agree, hey, I'm going to pay this back, and I'm going to pay it back over this time period. Here's where I'm going to pay you. Here's how much I'm going to pay you. And here's what happens when I don't pay you. Where do they come from? So promissory notes can be generated between any two parties that are going to agree on the repayment of some debt. Most of the time, it's going to be secured by some kind of collateral. And when I talk about collateral, that doesn't necessarily have to be real estate, although in this context, that's what I'm talking about. It can be shares of a company. They can be unsecured, which means that's like credit card debt. We'll get into that in a minute. But that's where you don't have any recourse of going and taking something that can then secure the principal of your loan. So there's a whole whole wealth of places where these things can come from. When you talk about types of notes, treasuries are a type of note. That's a IOU from the government. There are home loans, there's credit card debt, there's car loans, there's private loans between individuals. If I loan a friend of mine some money, we'll probably want to sign a promissory note that captures that, and that becomes his obligation to pay me back. There's student debt. This is not exhaustive, but that's just a couple of quick examples of where notes can come from. So here's just a couple of additional examples of real estate specific, well, not necessarily real estate specific, but additional places where notes will come from. So when people sell raw land, a lot of the times they'll take back a note and seller finance it because banks don't like to finance that. Single family home sales, this is probably the biggest category, or one of the biggest categories, right? So this is either you're going to Wells Fargo or you're going somewhere, an institution to get a loan. You'll sign a promissory note when they loan you that money. Conversely, when we start talking about seller finance notes, the same thing happens, except instead of a bank, you're dealing with an individual who is going to accept payments for the purchase of that home over time. You got business notes. This is something we see. Probably 20% of the notes that we look at are going to be from the sale of some kind of business. So sometimes there's real estate attached, sometimes there's not. So a very different animal when it comes to when you put your investing hat on. You're not necessarily looking at the value of the collateral. You're looking at the whether or not there's a personal guarantee involved with the business, what the business is, what they're selling, where they are, how big they are. Like there's a whole host of different parameters that you want to pay attention to when you're dealing with business notes. There's personal loans. These are, I already mentioned it before, it's just between two individuals. They can be secured or they can be unsecured. So these are private mortgages of a different kind, or private notes, I should say. There's the unsecured debt. Mentioned that already. That's kind of like credit card debt, right? So that's why when you start talking about risk, and I'll get into that in a minute, that's why these promissory notes will take on super high interest rates, because the risk of repayment, if the person that agreed to pay you back isn't going to pay you back, then you don't really have anything you can go after. So you need to command a higher rate of return to compensate you for that risk. And then there's commercial notes. So these are on buildings. These can be on businesses too, right? So if there was a piece of real estate attached to a business note, then that would be a commercial note, right? So these can be buildings. These can be mixed use, where there's residential, on the top and retail on the bottom. They take all kinds of forms. But again, all of these get evaluated in different ways. We need to ask for different rates of return and expect different rates of return for these, depending on their risk profile. And again, this is where I was saying you could do almost an hour-long presentation on any one of these. So let's talk about the different roles that people can play when we talk about notes. And really, I've boiled it down. This is, again, not meant to be exhaustive, but there's three primary roles that people will sit in when we start to talk about notes. So the first one is probably the one that most people are familiar with. This is the borrower or the payor. Right, this is the one where they have they've bought the property, they've agreed to make payments to the seller or the lender, and they're the same thing, on the note. And the risk the borrower takes, is that in the event they default, they will ultimately have to forfeit that property that they agreed to make payments on. So that's the risk, and the risk on the lender side. We'll get into that. That's kind of the next role that people play. These are the people that have sold the property, and they're the ones that are providing the financing that enables that sale. And in compensation for that, they are receiving the monthly payments with interest attached to it. And that loan is then secured by the real estate, right? So the risk is that somebody stops paying. The security is that if they do that, you have a way of going and seizing collateral and then liquidating that to repay your principal. And then the last role, and this is kind of the role that we sit in. Investor and lender can sometimes be the same thing, but the distinction is a lender is usually the one that originates the note. You're the one that sells the property, creates the note. An investor is somebody who steps in after the fact at some point later on and purchases the note from the lender, and then begins to receive those payments instead of the lender. And then there's a sum of money that gets exchanged there. But those are the three primary roles. Again, there can be nuances within each one of those, but I think it helps set the stage nicely to see that any investor or individual can kind of throughout their investing career and their lives can kind of occupy any one of those, and you kind of got to put on different hats when you're sitting in each one so that you're making the right decisions and you're doing it in an informed way. So let's talk about what a note, air quotes, looks like. And really, a note is comprised of two different documents. Sometimes these can be combined in the same document, but in 9 out of 10 cases, these are actually two separate documents. They are a promissory note, and they're a mortgage or a deed of trust. And a lot of the times, these terms get conflated into kind of the same instrument. So I wanted to make sure that we kind of separate them so that everybody knows what we're talking about. But the promissory note, this is like we mentioned before, this is actually the signed document that outlines the details of the loan. It's how much you borrowed, it is the interest rate you're going to repay, it's what happens when the payment's late, it's who is the person you're paying, where you're going to pay them, how you should pay them. You need to specify, you need to get paid in legal tender and sound money instead of getting paid in glass beads or something like that. So that document is actually, when we start talking about investing in notes, that's the piece of paper that you're buying. It's called a bearer instrument, and you can think of it just like a check. So a personal check, when somebody writes you a check, you turn around on the backside and you endorse it with your name, and then you go to your bank and you deposit it, and then they put those funds in your account from the other bank. When you are buying a promissory note, you're doing roughly the same thing, although obviously it's not identical. But you get an endorsement of the note, the actual ink signed piece of paper. And then that original, then whoever's holding it has the right to collect the payments on that debt. So that's the promissory note. On the mortgage or the deed of trust, this is the instrument that specifies the collateral and what happens in the event of a default. It doesn't necessarily always contain the terms of the deal. So the promissory note has that. The mortgage or deed of trust will usually contain the amount borrowed, but that's about it. And then there's a whole bunch of other, right? They're 8 or 9 pages long. If you've bought a house, you have read through one, hopefully. And this is where the lender is giving. I'm sorry, the borrower is actually saying, okay, you can have this if I don't pay you back. The distinction, another important distinction here, is that typically mortgages and deeds of trust are recorded with the county where the property sits, right? So we're talking about the real estate piece now. And that's to make a public statement that says, listen, this person borrowed the sum of money and they're pledging as collateral the house that I've sold them. And so that's where the distinction is. Promissory notes are traditionally not recorded with the county. And so when we start talking about the seller finance piece of it, you're dealing with individuals that have sold a piece of property. Sometimes they keep the original note. I'm surprised at the number of people that I talk to where they do not have the original note. And then there are steps that we take when that ends up coming up. So quick overview of the anatomy of a note. Okay, so now we're getting into the seller financed real estate notes. So here are kind of 5 areas that I'm going to talk about quickly. And we'll talk about, what is the seller finance note, how they're created, where do you find them, how do you invest in them, how are they different from, for example, institutional notes. And then we'll talk about quickly, I want to draw a distinction between notes, and CFD stands for contract for deed or land contract. Sometimes those two get talked about in the same way, and there are some distinctions that are worth mentioning when it comes to note investing. So private mortgage note, when we talk about seller finance note, this is the private note between 2 individuals. It's usually, when we talk about people in our business, it's somebody who has inherited a piece of property, they've paid it off, or they've lived in it and they paid it off and they own it free and clear. It's been a rental property that they sold to a tenant. Similar to a bank loan, but it's usually closed outside of traditional banking channels. That means that when you go to Wells Fargo and you are getting a bank loan for a piece of property, they're going to put you through a very long underwriting process. And it takes 30, 60, 90 days, sometimes longer, to get that financing closed. And they're going to look at everything. They're going to want to see your employment. They're going to want to see all your assets. They're going to see, everything. It's not a fun process to go through, anybody that's gone through it. Very exhaustive. And they do that because they have very strict compliance that they've got to abide by. When you come into the seller finance realm, those controls don't exist in the same way. It's really up to the person selling the property, how they underwrite the deal and how they decide whether or not they're going to lend this person money and trust that they're going to get paid back. And so when we look from an investor perspective, uh, understanding that underwriting and vetting it becomes very important, because ultimately that will determine the degree of risk that we are accepting when we're investing in one of those notes. So if we have somebody that brings us, a note that is written on the back of a napkin, and they are receiving cash payments from the borrower, and they don't have any record of them, that's a very different animal from somebody that goes through a mortgage loan originator. They have an underwriting package. They've seen their employment. They've verified their income. They have it boarded with a servicer who is a licensed entity that actually collects the payments and tracks where you are in the unpaid balance. They collect the payments. Those two things are very different. They carry very different risk profiles when it comes to an investing perspective. So that's a good kind of overview and kind of how we think about the seller finance world. When you're dealing with institutional paper, it's much more uniform, and they carry lower returns than seller finance note, because you are not necessarily having to scrutinize the underwriting as closely. So we talk about how they're created. Already kind of talked about this, but the buyer and seller basically agree on terms. Seller typically is responsible for the underwriting of the borrower, and then the servicing of the loan. When I say servicing, that means they are keeping copies of the payments that come in. They're keeping clean records on where the loan is in repayment, what the unpaid balance is, if they've missed any payments, any late fees that are collected. It gets to be kind of a burden, and that's a lot of people will sell a piece of property, and they'll call us and they'll say, "Oh my gosh, like I just want to get rid of this thing. It's a headache. It's the only one I've ever done. I didn't realize there was going to be this much record keeping involved." And so in that situation, we will either have a conversation about acquiring the note from them if they just want to get rid of it, or we will recommend they go board it with a servicer, and that way they can continue to collect those payments, and they don't necessarily need to sell it to someone like us. When it comes to creating a note, and I'll get into that in a minute, it's important to consider some of the things that I talked about as it pertains to record keeping and how clean you generate and underwrite the note, because that will ultimately then protect the value of the note you create. So we'll get into that in a little bit. Okay, so where do you find these things? I'm sure I haven't really sold in why they're so great. I'll get to that in a little bit. But they can be sourced from a number of different avenues. When you talk about institutional paper, so that's where a bank originated the note. Some people can, they recommend going out and calling the banks and asking if they've got assets for sale. I find that's a pretty tough road to hoe, unless you've got serious dry powder behind you and you can come in and be somebody that is worth talking to for the bank. Because typically they are either selling to large institutions, hedge funds, entities like that. So when individuals call them up, it's hard to take them seriously because they're worried if they're going to perform or not. Kind of one level down from that, I say you can get these on exchanges. These are starting to pop up. There are exchanges like PaperStack and a number of others. FCI Exchange used to be one, where these are kind of like online marketplaces where you can go and create an account, and you can shop loans that other investors are selling, or people that have originated notes are selling. And they will have certain, different degrees of information that are being shared about each one of the notes. And then at that point, it's a negotiation, between the buyer and the seller on the price and the terms and how those are required. But the nice thing about some of these exchanges, I'm thinking PaperStack in particular, is that they have really done a lot of good work around standardizing the process in acquiring an owner finance note from a buyer. So they'll do things like they'll validate all the collateral package. They'll act as the custodian, which means the one that actually handles all of the documents and funds in escrow, so that you're not just randomly sending a stranger some money and hoping they send you all the stuff that you need to then begin collecting those payments. Title companies are another good one. These are ones where, when we do our business, we always close notes through a title company when we're acquiring. But they're very much, if you're in a title company state, if you're in a state where you use attorneys, it's kind of the same game. But they are right in the middle of those transactions, and sometimes they know people who are holding notes, and they can put you in touch with them. Private individuals, that is a lot of what we do in terms of going out and actually looking for and marketing to those individuals that have sold a piece of property and are now receiving payments. And then we start a discussion with them and a conversation to see if it's something that might make sense to them to sell, and then we can then take that over. And then investment funds, this is kind of going back up to the top of the food chain, right? These are hedge funds that may be winding down or selling off assets. And if they are involved in debt, real estate debt investing, sometimes they have portfolios of notes that they will ultimately sell. So how are they different? We've already talked about this as well, but it really comes down to the scrutiny and the underwriting between bank originated notes and seller finance notes. And there's just a word of caution when you get into the seller finance realm. There's a whole lot of different considerations to look for as it pertains to underwriting, documentation, record keeping, et cetera, that can affect the returns and the risk profile of any note that you might be looking at. And then when we talk about notes and contracts for deed or land contracts, let me differentiate these two really quickly. So we've already talked about the anatomy of a note. It's the promissory note and it's the mortgage or deed of trust. Two separate documents. And the key distinction is that when you sell a piece of property or a seller sells a piece of property using a note and a mortgage, the title actually transfers to the buyer, meaning they're the ones that technically own the house with a lien on it for the debt that needs to be repaid. When you talk about a contract for deed or a land contract, title is not actually transferring to the end buyer until the debt is satisfied. You'll hear some people argue that, oh, well, it's nicer to do that because then if they default, then I don't have to go through a foreclosure. You do what's called a cancellation of land contract and a forfeiture. Some states, state by state on how these are treated. So sometimes that's an advantage. In some states and some jurisdictions, the courts will look at somebody who has been paying on a contract for deed or land contract for a long time, and if they built up a sufficient amount of equity, sometimes a judge will take a look at that and say, no, you can't just cancel a land contract and take it back. You have to actually go through a foreclosure, and so sometimes that advantage, that perceived advantage, is not always there. And the other consideration is if you own or you originate a land contract, you as the lender are still responsible for things like water bills and tax bills and all of those good things. And so you've got to keep track of that, because if your tenant or your borrower in this case is not paying those bills, then you could stand to lose the property. And that's never a road that anybody wants to go down. Versus when you go over to the note and the mortgage, you're obviously still responsible for the taxes. But with your name not on title, it's a little bit cleaner from a just what you're responsible for. So we tend to prefer notes and mortgages. We do own some CFDs, but tend to like the cleanliness of the title transfer that's involved with the note and mortgage. All right. Let's talk about investing in seller finance notes. There's really three ways that you can approach investing in this instrument. The first one, and this is the one that is closest to us because this is how we do it, is you can actually buy the notes direct from the originators, right? These are the people that have sold the property. I mentioned before that we are actually out there actively talking to people who have sold these and are negotiating sales for people that that think it makes sense for them. The second way, and this is the way that a lot of people that we know do it, is they'll actually go out and they'll create the notes. They'll originate the notes. And this is, we've already mentioned it a bunch on this presentation, is that this can be created from the sale of real estate, business, or can be unsecured. This is where you step into the underwriter's position, right? So you've got a piece of property and you are going to now vet people that you're going to accept payments from, knowing full well that if they default, then you're going to have to go through a foreclosure, which is not fun. Because you stand to have the property be damaged. It costs time and money, and there's opportunity cost. And it's just, you need to be very careful when you're underwriting these things. But if you are, for example, in wholesaling, or you've got some rental properties, this can be a good avenue to exit out of properties that you got. Or if you've got rentals and you have a tenant that's been paying you for 5 years and they want to own the property, and you want to continue to get the income, but you don't want to necessarily manage tenants anymore. This can be a good avenue, because then you can still get payments, and then the responsibility for the property is actually on your borrower now, the person that you would sell the property to. So we see a lot of people that do that. And then you can also invest in a fund. There are a number of people out there that operate investment funds that you can think of it kind of like a REIT, real estate investment trust, but instead they specialize in investing in promissory notes that are tied to real estate. And they can span everything. They can have land, they can have single family, they can have commercial. The benefit of doing it this way is that if you are doing kind of the first method, buying direct, You're putting slugs of money into individual properties, individual borrowers, and you're kind of accepting all of the risk and putting not all your eggs in a basket, but you're putting a lot of your funds against a single opportunity. And until you get a number of those under your belt, that risk is still pretty concentrated. When you talk about investing in a fund, the benefit you have is while the return might be lower, you are spreading your risk across a number of different assets, sometimes hundreds. And so if somebody defaults or they have to foreclose, you as the investor, if the fund is operating upfront and doing their job right, you'll still continue to get your return that the fund is paying out. These funds come in different structures. They can pay what's called a pref, which is just a monthly distribution. It's kind of like pure interest. And then at the end, when they wind down, sometimes they will share in any upside if when they liquidate the notes, if they realize a profit, then they will distribute that as a kind of a one-time distribution when the fund winds down, if it's got a defined time period, or if it's evergreen, sometimes they just continue to pay out the pref until you want to get out, and then you can get your funds that way. So that's a quick overview of how people can invest in seller finance notes. Let's talk about due diligence. So this is everybody's favorite topic. This is how you make sure you don't lose money. So when you start looking at the steps in kind of what it takes to close and buy a seller finance note, this is now speaking very specifically to our business. We find that it takes 30 to 45 business days to get one of these things closed. And that is all the way from when we first start conversations with somebody all the way up to when we are at the closing table and the seller is signing documents and funds are changing hands. So what I want to do is just walk through kind of these three phases, right? I've kind of broken them up, and every deal is a little bit different, but it starts with kind of the evaluation of the deal and making the offer, the due diligence, which is the formal period where we're evaluating title, we're evaluating the borrower, we're evaluating the property, pay history, all that good stuff, making sure it has insurance. And then once we're satisfied with that, then we move to closing, which is where we get a closing package together. We arrange for the seller to come in and sign, and then we transfer funds, and then we take over the note. So starting day zero, it's really about collateral review and evaluation. This is understanding, do they have the note? Do they have the mortgage? Original ink signed copies, wet ink signed copies. Do they have a pay history? How long have they been paying? Do they have insurance? Is it a house? Is it land? All these things factor into kind of what we're gonna require. Then we take a look at that information. We formulate an offer that's going to work for us. It's going to give us the return that we need. It's going to give the seller the cash that they need. Offers can come in a lot of different flavors. You can sell an entire note, or you can sell what's called a partial. And I'm realizing now I probably should have put a slide in here about this, but I'll go ahead and just talk about it off the cuff here. But when you talk about a full offer on an owner finance note, that's where we are talking to a seller and we're saying, look, we will buy the remaining payments for this note. So if you've got, let's say you structured a 10-year note, you've been getting paid for 12 months, we will buy the next 9 years worth of payments and we'll give you X dollars for that, right? Some people, if they say, look, we want to get out, we don't want to do this anymore, we hate our borrower, any number of reasons. I've got this other opportunity I want to invest in, the whys kind of run the gamut. But that's a full purchase. And from that point on, they are done. They have no more interest in the note. They have no more interest in the property. They take their cash and they go do whatever they were going to do. When you start talking about partials, this is where when sometimes we talk to people and they say, look, I only need a certain amount of money, which would be less than what we would offer for a full. So let's just, for making up numbers, let's say they have $100,000 note. We could buy the whole note for $70,000 to $80,000. They say, you know what? I don't really need that much. I just need $25,000 to go and do some renovations on this other rental property that I own. We say, great. Don't sell us the entire note. In fact, I'm telling you not to sell us the entire note because I can get you $25,000 at the closing table by only buying on that 10-year note. I might only need to buy 5 years. And at that point, they take the proceeds from the sale. They go do whatever they're going to do. For 5 years, we collect the payments. And then at the end of the 5th year, they have the option of either taking the note back over and continuing to get those payments again, or they can sell us the rest of the note, or they can sell us another chunk, another partial, right? So it gives them kind of the optionality to reevaluate 5 years down the line when circumstances can change. and say, hey, do I want to take these payments back, or do I kind of like getting the money and I kind of enjoy not having to deal with these notes or collecting the payments and keeping the records? I'll go ahead and sell the rest of it. So those are kind of the two offers that we will put in front of people, and understanding that why of kind of why do y'all want to sell? Why are you calling me? Is really really key in our process to getting the right offer that's going to do what they need to do. It's going to get them what they need to get, and it's going to get us what we need to get. So it's very much a win-win situation. When the note is sold, nothing happens to the borrower's position. They still continue to make the same payment, the same interest rate, the same term. Nothing about it changes. In fact, anybody on the call today, if you've had a mortgage, you probably had it get sold or transferred, and you get a notice in the mail that says, "Hey, you were paying Wells Fargo, now you're paying Bank of America. Now here's where you send your money." And that's basically what we do: is we notify the borrowers your mortgage has been sold. You were paying, Joe Smith. Now you're paying Gardner Capital Group. Starting on this date, please call our servicer and get set up. That's how it works. Okay, so then now let's say that the seller says, "Yep, that's great. Offer sounds good. Let's go ahead and move forward." Then they accept the offer, and we start our due diligence. And so what that ends up kicking off is we want to make sure that the collateral, the security on the loan, is what they say it is, and that it's worth more than the amount of money that they have loaned out. It's a bad situation if you've got $100,000 note and the house is worth 75,000, because if they default, then you're going to go get a house that is not going to pay you back all the money that you lent out. So you want to make sure that doesn't happen. It's also very important to understand that the property is still there and still in the condition that the seller is representing it to be in. We've had situations where we'll get a note and they'll show us pictures and we'll look at the address and it'd be great, and then we actually go and check it out and it burned down. Right, so the collateral's not even there anymore. That's a bad situation, and you want to figure that out before you end up paying the person for the note, because the borrower probably isn't going to want to make payments on a smoking pile of ashes. And then we start with document collection. This is locating the note, locating the mortgage, payment history, insurance, all those good things, making sure they have all those and getting them to build up the collateral file. And then at that point, we usually, not usually, almost always engage with a title company. Sometimes it's the one that did the transaction in the first place, and sometimes we will go out and source a title company that we work with. And the objective here, and this is from an investor perspective, and this is anybody that wants to go out and do this. I recommend it. I can't recommend it highly enough, to get what's called a lender's title policy. This is a little bit different from an owner's title policy. When you are buying a house, you typically have an owner's title policy, and that just means that if something happens, somebody has a lost uncle that way back in the day, and they come back and say, "Hey, I never authorized you to sell this house. That's still my house," and it can cause all kinds of problems. Title insurance is going to help make that right for everybody. From an owner's or from a lender's title policy perspective, now as the person buying the note, I want to make sure that if anything comes up that impedes my ability to have a claim on the underlying collateral, meaning I need to be able to go foreclose on that house. I don't want to get surprised and figure out that the title company, in all their due diligence, missed something. They missed something down the line that is going to affect my ability to foreclose. We want to make sure we avoid that. So we get a title commitment that's going to ensure the amount of money that we're investing, and make sure that we're in a good place, and that our position is very secured. So now we're in day 25. We're kind of in week 4, week 3, week 4, or week 5 at this point. We finalize doc collection. We do borrower interviews if we need to. It's typically a 15-minute conversation where we say, "Hey, verify the information. You're paying this much. Do you like the house? Are you making any improvements? Are you comfortable with the payments? All those good things." We want to make sure that everything is as it was represented to us, and we do that through a borrower interview. And then finally, we get a final closing package together and we schedule closing. And that's the part that everybody likes, because that's where, we get the note and the seller gets their money. All right. So let's talk quickly about landlording versus lien lording. And if you guys have done any looking on note investing, you've probably come across this distinction a couple of times. I traveled this path myself, and a lot of people I know in the note investing space have done the same thing, where they started off as traditional rental property investors, right? So they were buying, leasing, managing one or more properties, and all the headaches that come along with that. Some people are great at that; they love it. I just found that was not the path that I wanted to scale up. I found that it was it was a lot of work, and the returns were not agreeable to me and what I needed. And so it just having to fix things, manage management companies, no matter what, you're managing somebody. And that's not necessarily doesn't necessarily go away with note investing, but I'll juxtapose the two here in just a minute. Um, the one thing that landlords do get to enjoy is appreciation in the property. And a lot of people are probably nodding your heads, right? So you buy a piece of property, and when you sell that rental property, you get to capture 1031 the gain into something else. That's not necessarily the case with lien lording or note investing. Lien lording is just kind of a funny name for it. But that's the one thing that you sacrifice. So let's talk about lien lording. So that's basically being a note holder and collecting the payments for any principal that is lent out. Management's still a factor, but I find that it tends to be less, and this can be more scalable. Managing a portfolio of 20, 30, 40, 60 notes can be easier in a lot of ways than managing 60 different rental properties. Unless you deal with multifamily and you've got some efficiencies there. But if you're doing, 40 or 50 single family houses, I mean, that is more than a full-time job, right? So the compromise there is that with lien lording or note investing, you do not share in the appreciation of the properties that are being financed, right? That goes to the person that actually bought the property. So there is a trade-off, but I find that trade-off to be agreeable, because when we purchase these notes, we are purchasing them typically at a discount to the unpaid balance that has been lent out, and that is because to do that, if you have a note written at, for example, 6%, and we need to be making more than that. And I'll go into the last slide I'm going to show you, kind of justifies where the returns kind of sit on these things. Is that you need to offer less than what they are owed, because what happens then is you're still receiving the same payments that are agreed upon in the note, but your cost basis is less, and thus your return, or the returns you earn are higher, right? And that's very deal by deal. So I didn't have specific examples just because it can get so nuanced. So rounding this out, this is a burning question. I want to make sure I covered how you can lose money in note investing. No shocker that probably the top of the list is loan default. That's where your payer stops paying and forces you to foreclose, and you spend the time and the money to retake and resell the property. A lot of the times when we look at acquiring notes, this is something that we have as a contingency plan, where we know, hey, if this happens, we know we're very covered. And even if it takes us 12 months, 6 or 12 months to foreclose, we feel that relative to our investment, we can still liquidate the thing and make a return on the investment. There's an entire class of note investors out there. I am not necessarily one of them, that invests entirely in defaulted loans. It's called non-performing note investing. And that's where it is very much somebody hadn't been paying for 18 months. The current note holder doesn't know what to do. They don't want to foreclose. So they'll sell the note to somebody, and then the investor will go and do all the foreclosure and take back the property. They take on the risk that, somebody may not be cooperative. The property could be damaged. It could take forever to foreclose. In some states like New York and Cook County, Chicago, or Cook County, Illinois, it can take 2, 3, 4 years to foreclose on a property. And so you're paying property taxes, you're paying lawyers, you're paying all that stuff during that time period. So you've got to understand what you stand to lose from a time and a money perspective when you're making these investments. The second way is on the property value. So I kind of mentioned this earlier, but you want to make sure you got a good handle on what that property is going to command on the open market to a conventionally financed buyer. Because in the event of a default, you are going to need to foreclose and sell it. And if it's worth less than what you are owed, so if you're upside down, then you're out of luck. And whatever that amount over the value of the property that you are owed, you're not going to realize that. So that would be a loss. Invalid lien. This is why we get title insurance. Basically, if something comes in and they contest the lien, that's where you could stand to lose your entire investment because a judge may say that it's not valid. I've also kind of conflated these two. We're paying too much for a note. This is basically overpaying. It's the next one. That can result in lower than expected returns. So you want to make sure that when you're investing in notes that you are getting a return that compensates you for the risk, the time, and I kind of tongue in cheek say brain damage that it's going to take to manage and make sure that you're getting paid back. So overpaying for that will drive those returns down. And if all of a sudden your returns are equivalent to some other asset classes that have more agreeable criteria or agreeable features, then you need to start looking, okay, well, do I need to be doing it this way, or do I need to go over here to these other investments? And again, I'll kind of wrap things up talking about that. And then lastly, just like professional tenants, there are professional borrowers that will go out and they will, their game is to not make payments and to drag things out as long as they can. They can do things like declare bankruptcy, they can sue you, they can, every trick in the book to delay your getting paid back on the note. And time, like anything else, is money in this game. And so anybody that's going to string you along is going to cause your returns to go lower or negative, and or cause you a lot of trouble and headache that you might not necessarily want to be dealing with. So those are the 5 primary. This is not exhaustive. There's plenty of other ways that are kind of subsets and combination of these, but these were the 5 that kind of came to mind, as I was putting this together. Okay, so we're going to wrap this thing up here. We're zooming back out to talk about a quick note about risk. One of the things that I think a lot of people, they don't fail to take it into consideration, but I think they don't think enough about it is, opportunity cost and opportunities, alternate opportunities when it comes to investing. So when you start talking about the continuum of risk, I'm going to outline a handful. Again, this is not exhaustive, but these are just examples of an investment vehicle and the rough return ranges that you as an investor should be, and me, this is actually coming personally for me, this is how I look at it. If it aligns with you, then that's great. But basically, when I'm looking at different investment opportunities, saying, okay, what do I need to expect to get from this investment to compensate me for the risk, the time commitment, and then again, I like to say brain damage, stress, whatever you want to call it, that is going to be involved in doing that, right? So a couple of these examples, CDs, bank CDs and treasuries, this is particularly relevant now with interest rates being elevated because, you've probably seen advertisements right now. Bank CDs are in the, 4 to 6% range, depending on the length of time you want to lend the money. And they're, for the most part, pretty liquid, and they carry very little risk. So that's kind of your floor. So if you've got another investment opportunity that doesn't have the protections of, like, for example, the FDIC, or it's not very liquid, and you're getting somewhere around 5 or 6%, you need to look really hard and say, well, this other thing that maybe carries more risk probably isn't worth it. And then you've got public equities, right? So these are investing in the stock market, ETFs and index funds, 8% historical S&P return, right? So this can be anywhere, on either side of that, right? But that's kind of the center line. And you think the risks you take here are, you take market risk, which means that the S&P has a bad day, then you're going to lose money on paper. But it tends to be liquid. If you need to get out of it, you can go into your brokerage account and you can liquidate that ETF or that stock and get the money the next day. So you've got kind of two competing features there, and that's why the risk return profile is where it is. And you start moving up into real estate, right? Again, these numbers aren't meant to be prescriptive. They're just kind of, I'm showing relative growth as we move up the risk continuum. And that's the other thing is, as you get up the chain here, you're taking more risk in one way or another, but you're also being hopefully compensated with higher returns. So with real estate, 14%, 20%, depending on what you're doing, is kind of the realm. Again, these are not as liquid. If you buy a single family rental, it's not as easy to turn around and sell that thing if you need to get the money, right? So you need to be commanding higher returns for it. Then you move into private equity and venture capital. This is much higher risk. Some investments can go to zero, but the ones that win, you're going to get a much higher return. And then, of course, jokingly, crypto and other investments of that ilk, right? You need to be thinking about super high returns because you're taking a lot of risk, and you can certainly stand to lose your money if you are concentrating it, too heavily. So the reason I wanted to show this slide is to help you understand and help you to think about where notes, and specifically seller finance notes, can fit in. To that equivalent or to that continuum. Typically, we look at rates of return that are 10% above is kind of what our target is, and then anything above that is a bonus. Anything below that, we start to really take a look at. Okay, well, should we be somewhere else? So that is my last slide. Let me wrap up here. I mentioned there was going to be an opportunity to get a copy of these slides. These are a couple of ways you can get in touch with me if you have questions. I know we're going to do a quick Q&A here at the end. That phone number rings directly to me. The email goes directly to me. And then if you want copies of the slides, that QR code or that URL is going to take you to a small form page where just give me your name, your email, where I can send the presentation. And then, that's how we can stay in touch. So that is all I've got. Thank you very much, everybody, for spending time with me on a Saturday. And I will end the presentation
Thank you so much, Derek. That was amazing. Really good information. I think there were enough information on note investing, especially because it's such a good choice. Particularly with self-directed IRAs, I've seen that it's just such a good choice. It's very passive, and for people who just want to watch their IRAs grow, sit back and relax. This is a great choice. We do have a few questions that came in, so let's bring them on the screen here so that you can. Oh, sorry, so that you can take a look here and answer them.
Great. Yeah, JLo. So the question with mortgage notes, you get paid every month from people paying their mortgage. That's correct. So if somebody owes $900 a month on their mortgage, that is being paid to me as the note holder, and then part of that goes towards the interest, and part of that goes towards the principal, depending on where you are in the loan. And so the interest is our return, in addition to any discount we bought it at, and then the rest of it goes to pay down the principal. And then at the end, they pay it off, and we don't get the payments anymore. So that's the other thing that back to the lien lording versus landlording. Rental properties can kind of go on indefinitely, right? But with notes, they eventually get paid off.
Awesome.
Okay, who's next? Yeah, average interest rate on a note these days. So I mentioned that the thing that I tell people when they're going to originate a note is you are providing an amenity, right? Typically the people that need to own or finance a piece of property, they either don't have the credit, they don't have a W-2, they're not a standard lender from a bank's perspective. And so their only option to go and buy a piece of property is to go and seek out people who will lend them the money. And so when I say that, I see a lot of people that will, and these are maybe from a couple years back, but they'll charge interest rates that are, 3, 4, 5, 6%. And, when you think about that now, that's what, somebody with a 700 credit score and significant assets is going to be able to get on a home mortgage. So I tell them, don't do that. Like you're not a bank. Like these people can't go to a bank. So you need to be commanding something back from them for providing them that amenity. It's very much a give and take. So long way of answering the question. I tend to recommend average rates at the 9 and 10% level. And that then will protect the value of that note, because somebody like me who needs to earn that return will not have to offer it such a discount versus somebody that comes to me and has lent money for 30 years at 0%. Like they're going to hang up the phone when I tell them what I can pay them for that, right? Because I need to make that return. And then in terms of home that's a fixer upper, it really depends on what the collateral is worth like right now. Because if, I buy the note and somebody stops paying in month 5 and they're like, oh man, but I'm still getting these renovations done. Like it's going to be worth this. Well, it's not though. And we need to figure out, and then it becomes a conversation, right? So we are not in the game of foreclosing on somebody to get the property. I don't need to own houses all across the country or land, in the middle of nowhere. I want to just get the payments. And so that's where the other aspect that I didn't really cover in the presentation that I really like about it is that it is a very one-to-one conversation with the borrower, right? So if they're having a hard time, hey, do we need to restructure this thing? Do we need to change the monthly payments so that I'm still getting the return I need, but it's a payment level that you can afford, right? Those are the conversations that I love about this aspect of the business, because it can very much be a win-win situation in all aspects. So Cindy, I'm not sure if I answered your question, but I think I did. Okay, who's next?
Me too, yes. Have one more for now.
Yep. So when you foreclose on the property, a couple of things can happen. It will go to a sheriff's sale or an auction. And typically what you do then as the note holder is you'll bid what you're owed on the property, and maybe a little more, right? And the idea there is that if somebody comes in and bids more than what you're owed, they will pay a cashier's check. Your lien gets paid off out of those proceeds. So you will get paid 100 cents on the dollar, hopefully. when that sale goes through. Now, sometimes you will get the property back if you bid what you're owed and nobody else bids higher, then it's your house. Now, there's a couple of options for you at that stage. You can go and sell it to somebody else and create a new note, right? So back to the Cindy's example earlier of the fixer-upper. Maybe it's the old handyman special, right? And you find somebody that wants to come in and fix it up, and you sell it to them on a note, and you can structure that note however you want, right? That's where you have the opportunity to kind of reset things. And then all of a sudden you might be getting the cash payments back again. Or you could just turn around and sell it for cash to somebody else and kind of wash your hands and, learn from what happened and either do that again or don't do that again. So it says go back to that. It says it's been said that you should not loan on property that you don't want to own. Yes. Some people, that's their objective. Some people, they want to own the property. And sometimes you can end up with them and it can be fine. Like it can turn into a nice rental, or you can sell it again. There's a whole bunch of different exit strategies. The key when you're looking at these opportunities is saying how many of these different exit strategies are viable. And then, which ones am I comfortable going down, right? And if it's like, man, I do not want to own that house, then you might want to pass on the opportunity. Okay. Just want to make sure I hit that second point.
Yes. We have a couple of thank yous from different people. Sorry. And so thank you for those. And then we have another question from Alfonso Munoz.
Yeah. Oh, tapes from brokers, and that's all that's on there is junk. Probably so. I go out. The reason that makes my business different from a lot of these brokers that are sending around tapes is I'm out there sourcing mostly newly originated notes. So these are people that have just sold the property. Maybe it's in the last 6 months. And then I just keep an open line of communication with them and educate them on what I do and how it's done and how it can benefit them. I'd say 9 out of 10 of them, they say, you know what, I don't want to sell it for less. This is not going to fit my needs. We say, great, we part ways and, we move on. But it's having those individual conversations with people who have sold a note is, Alfonso, really where you've got to sort through, kiss the frogs, separate the wheat from the chaff, whatever you want to say. But that's why I can command the returns that I do, is because I've actually gone out and done the work and sourced the notes and then found the ones that are worth buying, and added those to our portfolio. So.
Awesome. Well, I think that's it for questions for now. I want to thank you again, Derek, for joining us, and everybody that joined us as well. Derek and everybody, this webinar will be posted on our YouTube channel. And then, so yes, if you have more questions for Derek, go ahead and reach out to him. And if you have questions for us at Quest, reach out to us. Thank you, everybody. I hope everybody has a great weekend.
Thanks, guys.
Thank you, Derek.
Have a great weekend.